Okay, good morning, everyone. It's 10 o'clock. We're ready to get going. I want to welcome everyone to Colliers webinar. We've got our full panel on this morning, and the session this morning is titled The Evolving Lending Landscape. My name is Richard Jankowski. I'm the Managing Director with Colliers in Saskatchewan, and I'll be your moderator today. Hope today's session is timely for you. And I encourage you to jump in and send questions as we move through the presentations. Like all of you who've grown into webinar warriors these days, we've never learned so much in the present, yet had so many questions about the future. And then there's COVID. When will it end? What will it look like when things are over and on and on? And it's happening in every industry and every geography. It's been almost 150 days since our province declared a state of emergency on the 18th of March. Since then, we've learned a lot about the disease, albeit without a cure, but the questions and clarity on the economy seem to be relentless and mostly unanswered. Property values and financial liquidity remain front and center with all stakeholders involved in commercial real estate. So today's presentation is intended to provide an assessment on lending into the commercial real estate sector, mainly within our province, but after taking a look at the big picture. The process to get to bona fide conclusions was built by first looking at larger markets that may have enough deal volume to offer bona fide indications on values, then listening to what investors are saying and feeling these days. Next, considering the interrelated economic situation of a neighboring province, and last, summarizing some of the key observations for our province. In essence, we work backwards to get to our conclusions, and we hope the information resonates with you. So I want to introduce our panelists, and if we can move to the next slide. Thank you. So John Stewart, Senior Vice President and broker with our National Capital Markets team, is on from Toronto. We'll kick it off, followed by Adam Grisick. He's director from our Valuations and Advisory Services team in Calgary. Ryan Archer, Director of Expropriation and Litigation Services in Edmonton. Riley Young, Associate Vice President from our National Capital Markets team in Vancouver. And closing it out will be Dallas Mars, Senior Debt Advisor from one of Colliers' newest service lines, the Debt Advisory Financial Services team in our province. In terms of the information that John's going to cover, it's important that we have a session on the Canadian capital markets and tying in the effect of COVID on investor sentiment, what he's seeing within each asset class. That's going to be the benchmark for today's presentation. Adam's going to take a look at the Alberta economy. We always wonder if we can gain insight from our neighbor whose economy is so connected with ours. They've GDP in 2019 at $334 million is roughly 4 times the size of ours at just over 81. So we can learn a lot from observing this large machine next door. Ryan will share some looking back as we look forward stories, I call it, from his experience in the Alberta market, where swings in that economy and growth, inflation, and interest rate spikes have been dealt with before. Riley's going to give us the West Coast capital markets update. Vancouver's its own entity in many ways. As a foreign trade and investment destination, there's no doubt that the success of the West Coast plays a role in the Canadian economy. And then Dallas will close things out as he sees it for Saskatchewan. So with that, it's my pleasure to introduce John Stewart. John brings 13 years and over $6 billion of investment brokerage transaction experience in the office, industrial, retail, and development land asset classes. He has led disposition assignments in every major market across the country, including Saskatchewan. Over his career, John has successfully represented many of the largest and most active public, private, and institutional investors in Canada. So John, take it away. Welcome and thank you.
Great. Thanks for the intro, Richard, and thanks for inviting me on this panel. So as mentioned, yeah, our group, we sit in downtown Toronto, but we do transact on a national basis. We've done deals from Victoria, British Columbia to Halifax, Nova Scotia, and everywhere in between, including a number of deals in Saskatchewan with our team, in Saskatoon and Regina. So really, I'm here today to give you kind of the high level overview on what investors are seeing on a national basis and key themes in the investment market. So on this page here, the beginning of the COVID crisis, we saw a lot of our client base looking internal and focusing on a lot of asset management considerations. You know, are their tenants going to be able to continue to pay them rent on an ongoing basis? We did see a shift in mentality probably around June, where groups felt a little bit more comfortable about the management of their portfolio and the collection of rent and started to look outwards again and look for potential new opportunities. We started to see some off-market deals, maybe some selective marketing around June. Not a lot of transaction volume at the time, as we did experience a bit of a price disconnect in terms of vendors and buyers' expectations. But we're starting to have our clients ask us now, when is the appropriate time to go to market with new deals, new disposition assignments? And depending on the merits of those deals, asset classes, geographic location, the answer could be now. As a matter of fact, we're going to market with a portfolio here in the GTA in about a week or two that would be over $110 million in value, mostly industrial, but some suburban office as well. And part of the reason why we're seeing the mentality shift, I know this is a very much a debt-focused panel, is we did start to see the debt markets open up around June. I'm not going to go into too much detail because we have a lot of esteemed panelists to talk about that in more detail. And I'm sitting in my office downtown Toronto today. I certainly would have been here in April and May. So just the business sentiment and the business confidence has started to return to the market. And I mentioned our deal that's coming to the market, but we're anticipating we're going to see a lot more deals come to the market in August and September. Historically, Q4 is the busiest transaction volume quarter in any year. We think that'll be the case today, but we don't think volume will be back to, call it your historic Q4 transaction volume. We can go to the next slide. So this slide here, this takes a look at national transaction volume by asset class, and we have it broken down by quarter. We're showing a year-over-year comparison Q1 and a year-over-year comparison Q2. Obviously, the COVID crisis started late in Q1, and commercial real estate transactions have a long deal cycle, so we didn't see a lot of impact year-over-year in Q1. Q4 is when we really started to see the effect of the COVID crisis on transaction volume, and as you can see here, Q2 year-over-year transaction volume is down over 50%. And that is a number that would be consistent with other major markets across the globe, the US, Europe, Asia, etc. We would anticipate that Q3 volumes will be similar, down about 50%, similar to Q2. We are anticipating some transaction volume to increase moderately in Q4. The other comment I want to make on this page is just about the differences in asset classes. There's going to be a theme as we kind of go through my presentation slides about certain asset classes faring better than others. And right now, by far, the industrial asset classes fared the strongest. And you can see that in the Q2 transaction volume only being down 15%. Okay. This next slide here takes a look at the TSX Composite Index versus the TSX REIT Index, and it shows their performance over the course of the year. Surprisingly, but to the upside, the TSX Index has actually fared exceptionally well. We obviously saw a significant dip in March after COVID, but we've recovered significantly. Real estate tends to lag that. So when you look at the TSX REIT Index number, that's the dark blue, we're still down about 25% from peak value, but again, real estate tends to lag the broader economy. And then the chart in the bottom left just shows by asset type, by REIT segment, the implications of value from their highs at the beginning of the year. And that theme continues here. As you can see, the industrial asset class has continued to fare the best, with the multi-residential asset class continuing to fare the second best. The decreases in value on the left-hand side, those are not a proxy for underlying asset values. There's obviously a lot of other factors that come in to valuing a REIT, but the overlying sentiment would remain the same. Thanks. This next page here provides some historic context. So it's a look back in time at what happened during the global financial crisis in 2008, 2009, as it relates to real estate values in Canada. So what's interesting about this chart is you can see when the crisis hit last time around, we saw cap rates increase on average sort of about 150 basis points. And it took roughly 18 months for those cap rates to return to pre-recession levels. This time around, we've started in a much stronger position with cap rates already being lower. Our expectation is that the timeline to recovery will be similar, but we're not expecting to see the change in values across the board to be 150 basis points or anywhere near where they were for the global financial crisis. What we're seeing is our clients are going into this crisis obviously a little bit more cautious, but overall they haven't changed their return requirements for what they're looking to buy. But what they have done is they've changed their underwriting assumptions to be a little bit more cautious, i.e. lower rent growth, longer vacancy time, higher tenant improvement allowances, et cetera. So when you bake all that into a financial model, the implication of value is, down anywhere from sort of 5 to 10%, which is a long way from the 150 basis points that we experienced in the global financial crisis. So this next page here, this is sort of a summary of a survey that Colliers undertook throughout the COVID-19 crisis. So what we did is we prepared a series of questions that we went to our investor base, and our response on this was actually quite strong. We had a couple of hundred investors across the country respond to our survey on an ongoing basis. This would be a combination of institutional, public, and private developers. So we asked the same questions over a period of time, and it was interesting to see how those results changed over the course of the COVID crisis from start to kind of where we are today. So the first question, how long until we see the market stabilize? Now, obviously, April 7th, that was pretty new into the crisis, and there was a lot of uncertainty. And investors thought the markets would, it was kind of a 50-50 split between people who thought the market would recover within a 12-month period of time, and a 50% split between those who thought it would take longer than 12 months to recover. Our most recent survey results from June, I guess the realization has set in, and 87% of the respondents now believe it'll take 12 months or longer for recovery. So now that we've been in the crisis a little bit longer, everybody thinks it will be similar to that 18-month time period we saw in the global financial crisis. The next question we asked was, when will your next acquisition be made? At the beginning of the crisis, most respondents said that their next acquisition would be made. 77% said it would be 6 months or they're unsure. Whereas now we've seen more confidence return to the market, and 73% of investors say they would like to make their next investment within the next 6 months. So that was 77% would be 6 months or longer, whereas now 73% would like to make their next acquisition within the next 6 months. So a sign that confidence is returning to the market. A little bit of a disconnect though on question number 3. When would you like to make your next disposition? It has been consistent, sort of in the mid 60% are unsure. That was at the beginning and consistent now to COVID. So lots of people want to buy, but people are still unsure on the sell side. So a little bit of a disconnect there. But we have seen, as it relates to valuation, question number 4, we have seen a little bit of confidence return to the market as well. So at the beginning of the COVID crisis, almost 60% of our investor base thought that values would decrease more than 10%, and actually Quite a bit thought it would be 20% or more. So pretty negative sentiment at the beginning on what was going to happen to values. Now that we're a little bit more through the crisis, as of June 23rd, 68% of our investor clients thought that values would only decrease 0 to 10%. It's very much in line with my comments on underwriting before. And actually 17% of those investors think values have gone up. Those must be people who own industrial. Thank you very much. My last slide here, this just touches on all of the major asset classes and sort of the sentiments we're experiencing. From an office perspective, most major markets across the country were faring exceptionally well from an underlying fundamental perspective going into the COVID crisis. Downtown Toronto and downtown Vancouver had the lowest vacancy rates of any office market in all of North America. So exceptionally strong performance. There were some challenges in some markets, obviously the Alberta economy, which we're going to talk about in a little bit more detail. And Saskatchewan had a little bit of an overbuilding situation, but by and large, a good position to go in. Everybody's asking what's going to happen with work from home. Is there going to be, a significant decrease in long-term office demand moving forward? Our investor clients think that things will normalize, and they think that any short-term offset in work from home demand will be mitigated by increased workspace required per employee. The industrial asset class, the theme, it's been exceptionally strong throughout COVID. Obviously, e-commerce has only picked up with everybody at home, ordering groceries, et cetera. And there's going to be a little bit more reshoring of manufacturing of things like PPE, et cetera. So we think that asset class will continue to fare well. Retail, some of the themes that we were experiencing pre-COVID, large, big box, enclosed malls having challenges. Those have only been sort of exaggerated during COVID, but retail assets such as daily needs and grocery anchored have fared exceptionally well. Multi-res has performed well. It'll be interesting to see what happens after the government income program stop, but by and large, that asset class has performed well and is still in demand from a buy side perspective. So those are my high level assessments on the market, and hopefully that adds some value to the conversation today.
Thanks, John. It'll be interesting to see how your information correlates when we get down to Ryan. Definitely the industrial market sitting there on its own as almost an island. And nice to see the evolving opinions of investors. I want to introduce Adam Grisick, Director of Valuation and Advisory out of Calgary, just to talk a little bit more about the economy out there. Adam's worked primarily in the appraisal of industrial, mixed use, multi-residential and retail properties. In addition to those asset classes, he's got experience in the valuation of aircraft hangars, interesting, automotive dealerships, hotels, cannabis facilities, and redevelopment lands. Adam, take it away. Welcome.
Thanks, Richard. And thanks to everyone else who's joining in on the call today. So what I want to talk about today is just a little bit about the economy in Alberta. We've been in recession crisis mode for 6 years now. So COVID is just another blip on our radar, really. So the first thing that we got to talk about when we talk about Alberta is crude oil prices. Vacancy rates for Class A office in Calgary tend to have an inverse correlation with the price of Western Canadian Select. So the vacancy rate for office continued to climb because of the lag from the effects of the broader economy. So we didn't actually see vacancies start declining until 2018. This somewhat correlated with a stabilization of rents as WCS found support in the $30 to $35 per barrel range. You'll see there's been a couple of significant shocks since that, but we are trading around $30 now, and landlords have evened out their rates at about $15 net. Now, it should be noted that they provide significant inducements to get those rates. There's lots of $0 NER deals that happen. The other point I want to make about Class A office in Calgary is that they have been subject to significant write-downs already in the past 5 years, which does mitigate the downside risk. However, those buildings that have chronic vacancy issues or below average tenants will likely continue to trend down and be difficult to finance. So that brings us to the glut of office space. We built a significant amount of office in the past 10 years. Brookfield Place, Telus Sky, the Bow Building, all being completed, adding millions of square feet to the market here. Most of our tenants are oil and gas focused. And not only that, but their tenants, other tenants such as professional services, accountants, lawyers, what have you, their clients are these same tenants. So there's a negative trickle down effect. You know, the building that had occurred, that's sort of typical of real estate cycles where you have a big construction boom right before a market downturn. And as a result, you know, we don't anticipate there's going to be any new office construction for many, many, many years. Echoing John's statements on the impact of COVID, I think there will be some shift to work from home. However, this could be buoyed by a need for larger office floor plans or more private offices. My instinct is that the impact from COVID on office requirements will be more short-term in nature. So moving on to the next slide, just talking about in general where we anticipate our GDP growth and our unemployment is going over the next 5 years. You know, 2020 is going to be a weak year, but that's true of the world in general. GDP is down globally, and that's no different for us. So likely it'll take 2 years, you know, 2021, 2022, before we see any return to normal. Despite that, Calgary remains a good place to live. Population is expected to continue to increase. More than likely, what we're going into here is a more normal economy rather than a booming oil and gas driven economy. So without any significant catalyst, once the effects of COVID sort of normalize and things get back to normal, we're anticipating fairly inflationary GDP growth at around that 2.1%, assuming that the CPI growth over the same period does remain at that 1.8. You know, we're not going to be hitting any home runs here for a while. Looking more specifically at some of our asset classes in Calgary, again, industrial is faring very well. What many people may not realize if you're not looking at Calgary every day is that most of our industrial assets here are in distribution and logistics. We have access to over 16 million people within a day's drive in Calgary. So it's a great place for distributors to set up shop. We have Amazon fulfillment centers. Home Depot has 1 million square feet. Lowe's is adding over 1 million square feet. So these will bring jobs, and industrial investment and industrial assets are expected to continue to, you know, be around that 6 to 7.5% vacancy rate and generally be fairly resilient. Also, you know, echoing what John said, we may see some reshoring of manufacturing, which would help some of the more service-based facilities in Calgary that have suffered. You know, properties that would have produced piping or pump stations, for example, for oil and gas users, they could be repurposed to do other types of local manufacturing. Industrial landlords, further, they haven't significantly adjusted their rents for COVID. I have seen some who will offer a year one incentive lower rates just to fill space during COVID, but in general, rates are pretty stable. We've talked about office. You know, downtown office will continue to struggle with vacancy. It's likely going to increase in the short term. The Beltline and suburban vacancy, there has been a flight to quality from these assets over the past 6 years. but the costs have come down significantly for tenants to occupy them. So the trend of negative absorption may reverse in the next couple of years. Retail is a bit of a question mark. It will depend largely on what sort of stimulus packages the government continues to offer in terms of wage subsidies, et cetera. Putting money in consumers' pockets will help buoy retail, but we have seen vacancy jump an estimated 2 times since pre-COVID levels. Calgary's also struggled in regards to increases in property tax and increases in minimum wage. So that's making it hard for mom and pop retailers to keep their businesses running. So we expect that retail assets that are occupied by those types of tenants primarily will see the most challenges, whereas A-class retail that's very well located in popular shopping districts will not be as negatively impacted. Investment sales, there's not much to say about it. There hasn't been much activity in investment sales in Calgary. I would anticipate that we're going to see most investment sale activity in industrial real estate. That's been the trend over the past couple of years. That's where the biggest deals have been done in Alberta, has been in industrial investment. So again, just touching on the lack of high dollar value transactions, complete drop off in Q2 of 2020. And even the one sale that we do have, being an industrial transaction, it was negotiated prior to COVID. I am aware of a smaller, but an $8 million deal that was a private sale that's occurring right now. It's a value add type purchase. I do know that some private landlords in Alberta are finding opportunities in value add still, but there's a bit of a wait and see approach being taken without question. So overall, in terms of values in Alberta, we will we're going to see probably generally flat values for industrial assets, maybe a bit of appreciation as we move out of COVID. Apartment has remained strong. Retail likely is going to go down somewhat. Office is likely going to trend down somewhat. If you're financing property, strong tenant covenant is going to be a very significant factor. And that is what I have to say about the Alberta market. Thank you so much.
Thanks, Adam. You know, nice to see I think one thing I'll get you to come back to, and we do have a question in from one of the panels, so we can cover at the end as well, but just that longer view that you had on the economic situation running out to 25. If we start looking at things on a quarter by quarter basis, it does lend to hyper paranoia. All right, so we're going to move over to Ryan Archer. And so Ryan's got a long history in the appraisal industry going back to 2003, which includes experience in single family residential, industrial, retail, office, the gravel resource sector, which I thought is interesting, and development land. Since 2010, he's been providing litigation support to clients on property value and compensation related issues, with a focus on expropriation service rights related matters. He's appeared as an expert witness before the courts in that province, surface rights boards, the Utility Commission, and Métis Land Access Panel, and is past president of the Alberta Expropriation Association. So welcome, Ryan. Looking forward to some of the war stories that you've had to deal with in your experiences over the last decade or so.
Thank you very much. So, as you mentioned, one of my area of focus is on expropriation litigation, and a subset of that would be doing insolvency work. So I've been appraising for 17 years. My dad was also an appraiser as well, so I've been around this a while. but one of my first commercial mentors back in 2004, 2005. I remember he always used to tell me about the early 80s, and the best money he ever made as an appraiser was, 83 to 85. He'd roll around making about $1,000 a day, which is, maybe by today's standards, is not too shabby. So, fast forwarding to the financial crisis, in 08, 09, my first, I guess, adversity I faced in my career in terms of trying to find work, I started trying to chase down some of that insolvency work that I just expected to magically appear like it did in the early 80s. And I remember cold calling a bunch of lawyers and probably 40 of them. And over the next 2 years, I think I got two foreclosure jobs. So fast forward again, things were good again. 2014, things are rocking, probably better than 2007, quietly even. At that point, I was working with a firm that local firm that emphasizes solely on litigation and expropriation. And so again, thought as things started to go through a downturn in 2015, I was going to get a ton of that work. Well, since then, I've probably been getting about 5 a year. Not a lot considering that, again, Alberta's been kind of beaten up for the last 5 years, and thought there'd be a lot of it. What's interesting, always thinking about why there wasn't more. I talked with some colleagues over the years, and it really kind of came down to the conclusion that it's much different than the 80s. Interest rates are much lower. Guys can weather the storm longer. And the reality is that if you don't have to sell, you wouldn't. And that's one thing that we did notice in some of those downturns, and going into 15 and then, obviously 08, 09, just looking at the sales volumes, they were considerably lower than they were at their peaks, obviously. But the reality is that why would you sell in a depressed market if you don't have to? I think that's one thing I think we're probably going to see again, but maybe to a lesser degree. Another point is, in the preparation of this, I reached back to one of my former colleagues who also manages the Gettle network, which is probably the best source of commercial data in the Edmonton region anyway. And so not only tracking sales volumes, but interestingly enough, they've been tracking the foreclosure numbers. One of the weirdest stats that I found was that year-over-year foreclosures over the last 15 years are effectively unchanged, which caught me by surprise. So they are tracking that right now. Unfortunately, it's a little bit early in this at this point to know where that's going to go. But again, looking at sales volume as well, June was strong. A lot of those were deals that were already in the queue. July's numbers aren't out yet. I guess we'll find out. In August, they're projected to be lower as well. So just looking at where, talking with different brokers around the city here, they're definitely not making a lot of deals right now. So I think it's pretty obvious that when those numbers shake out, they are going to be lower or almost non-existent. They are doing a lot of leasing, but actual sales transactions, not much. The stuff that has happened that I'm aware of was a lot of smaller industrial condos and stuff like that. But the larger stuff, I do personally know of some deals that have happened. There's a big one in Nisku, which kind of shows where, the Edmonton market might end up being shaken out a little differently on the industrial side than everywhere else in Canada. It's kind of like I always joke that the Calgary office market is like Edmonton's industrial market. They almost in sync with each other. They don't really know what the vacancy rate in Nisku is right now. They think it might be 30-40% for all they know, but they can't even really actively track it right now. So that's one thing. And the one that I do know of, it actually ended up going at about 30-40% discount of where it probably would have been about 2-3 years ago. So that was a bit scary. That said, I know Adam does a lot of cannabis facilities. I was involved with one in Edmonton, and it actually went at a pretty typical rate, just showing that there was the continued demand for that sort of facility. Was really unscathed. So that was interesting. So thinking back and looking what we saw before, where does that put us going forward? Well, I've been wrong the last 2 times thinking there was going to be a lot of foreclosure work coming. I still do think that is happening. I think there will be more. When I talk to lenders and hear the stories in the first 3 months of COVID where, they were getting phone calls from guys crying, grown men, quote unquote millionaires crying on the phone, asking for help. And it almost seemed like the first 3 months they were just monitoring who they could save, who they couldn't. The good news is I'm hearing from those same lenders that they're starting to make deals again. So they're starting to lend again. Obviously, and then looking at guys being able to hang on. I mean, as Adam pointed out, and with the Calgary office market, rates have been adjusted. I mean, we've been struggling inching along here for 5 years in Alberta. It's not like this is anything new. I mean, guys have already tightened their belts and tried to lean things out a little bit. So, another kick. Well, maybe it's a nail in the coffin, maybe it's not. But the reality is that right now it's still just too soon to make an accurate prediction. So that's pretty much all I have to say.
Okay, thanks, Ryan. Good story. I'm sure you're going to get some questions at the end from some of the attendees. Riley, welcome. So, just so everyone knows, Riley's a key member of the mortgage finance group with Colliers out of Vancouver. His experience is pretty broad as well, working with client borrower types, including private investors, developers, owner-occupiers, institutions, hospitality sector, REITs, and foreign investors. Just as important as that, he has a considerable experience amongst many suppliers of debt and equity capital markets, including banks, credit unions, conduit lenders, life cos or life insurance companies, pension funds, international lenders, and private sources. So Riley, what's going on? What can you share with us today?
Yeah, thank you, Richard, and thanks everyone participating in the webinar. As Richard mentioned, we arrange financing across all asset classes with a focus on the West Coast, but have done deals across the country. So I thought I'd start with discussing what's happened with the most active asset class in Vancouver for the past number of years. In the Vancouver market, as most people know, land and redevelopment sites have really dominated transaction volumes and were extremely active for a number of years leading up to 2017. As a result of this, many lenders reached their capacity when it came to financing land, so they effectively couldn't do land loans anymore unless you were really a tier one developer. What's happened there is it really pushed many developers to take higher interest loans at 9 or 10% with alternative lenders that sometimes are a little bit more aggressive. While an institution might do 50% of land value, some alternative lenders will push that up to 65%. This happened at the same time as construction costs were rapidly rising, which really created kind of a perfect storm for redevelopments to become financially infeasible at the cost base that developers acquired the land. Since 2017, which really was the peak of the residential market here, the residential market has softened, especially at the higher end. And when I say higher end, I know obviously, in different markets, higher end is, different price per square foot. In Vancouver, what's kind of considered higher end would be anything over $1,500 a square foot on the residential side. So what happened is with the softening of end values and increased construction costs, when we look at land values based on a residual development method, we've seen some sites come off as much as 30% from their peak in 2017. So then we had COVID hit in March, which effectively shut down the pre-sale market for residential condos. So as a result, many of these market residential projects that were in the works have been stalled and or canceled altogether, evidenced by condo starts are down 75% in Vancouver this year. And many of these projects, developers have had to rethink them and move towards building rental. Going back to kind of the land financing aspect, most lenders only want to stay in land loans for kind of 12 to 24 months. So what we're seeing now is land loans that were at 65% of purchase price at the peak of the market in 2017 are coming due. And while those loans may have been 65% at purchase, some of those are now looking as high as 90 to 100% leverage based on current market values. And since these projects have stalled, it's basically creating very difficult decisions for both lenders and borrowers come maturity of those loans. So what's happening is borrowers are either having a large capital call to pay down the loan to a more kind of acceptable level, or hopefully if the lender is open to it, offer renewal. Lenders at the same time have to navigate this as to whether to renew those land loans. They can see if the market's going to turn around and the developer can get themselves out of the situation, but at the same time, they need to kind of balance that with the fiduciary duty to their shareholders. Either way, it makes for a very difficult refinance to pay off existing lenders if a renewal isn't offered and the developer doesn't have very deep pockets. So what we're starting to see is an uptick in foreclosures and defaults. So we've seen a lot more workout situations that are kind of coming to the market. And as a result, our expectation is over the next kind of 12 to 24 months to see a fairly large increase in redevelopment sites coming back to the market that were acquired over the last few years. Now, all of that being said, we are definitely seeing the residential market pick back up. July home sales were up 28% from the previous month, with 22% increase from July 2019, which is 9.5% above the 10-year July average. This is likely due to a lack of supply, due to the decreased starts that I kind of previously mentioned, as well as we've had kind of pent-up demand from buyers from the previous months that may have been out in the market in spring, and then COVID hit and people were trying to figure out how to kind of navigate the new normal. But we're definitely seeing a pickup on the residential activity, which of course was resulting in signs of some upward pressure on prices again. As it relates to lenders and spreads and interest rate costs, spreads kind of pre-COVID were typically around 185 to 200 basis points over Government of Canada bond yields. Almost immediately once Canada was sent into lockdown in March, spreads shot up to 300 to 350 basis points over Government of Canada's to basically factor in a new risk premium basically overnight. So what we saw was, a 1 to 1.5% premium almost immediately on what lenders would charge for their interest rates. Once everyone kind of got a better understanding of what was going on, we've definitely seen spreads slowly come down over the past couple of months. So right now, they're around kind of 225 basis points over Government of Canada bonds and appear to be continually dropping. So there's still probably a 40 basis point premium to where they were, but we are seeing that come down. I can tell you anecdotally, we had several loans with term sheets that were in March that were waiting for credit approval, only to get turned down at credit. And we are told that it isn't a decline, but basically they need us to resubmit in 3 to 4 months once they kind of navigate what's going on and how this is going to affect their business. Many lenders really turned off the taps to new clients and decided to focus inwards on their existing client base. This has eased up a bit, but we're still seeing it with some of the smaller financial institutions like credit unions, for example, where they're reluctant to take on new clients. Again, this is starting to ease a bit now that they've navigated all the mortgage payment deferrals, etc. But it's not back to where it was previously. There is still ample capital out there for the right borrowers and the right asset classes, but lenders are definitely being much more diligent on the product type that they're lending on, who the borrower is, who the tenants are, and they're asking a lot more questions surrounding susceptibility to shocks in the business of the borrower, as well as the tenants due to COVID. Prior to COVID, tenants, the due diligence around tenants wasn't too thorough. Of course, they're looking at who the tenants are, what kind of profile they have, etc. But they're really doing a lot. They're really focusing a lot more on the tenants, just to make sure that you don't have a situation where you've got a large percentage of your tenants in a building that won't be able to pay rent, and therefore the owner won't be able to pay their mortgage. I suspect as the year progresses, of course, provided that COVID doesn't have a large resurgence in the fall, lenders will start getting more aggressive as they still have their funding allocations. Most lenders we've talked to really haven't reduced their allocations for the year in terms of funds that are available to lend. And so I suspect as time passes, credit will ease up and rates will continue to decrease down. That pretty much wraps up my observations on the lending environment on the West Coast, which hopefully provides some insight into debt capital flows into our market.
Thanks, Riley. Yeah, that our strategy of working backwards from the large markets and taking a look at things on a national basis and a regional basis, discussing the economy, what's going on in the real estate market, ends with Dallas. So Dallas, the challenge is going to be with you to stitch this all together and talk about what it means to Saskatchewan. when we started Debt Advisory Financial Services here in the province, the goal was to add that extra piece of connectivity to clients and an extra service platform, a service offering. That was about a year ago, and I was really pleased to have Dallas join our team. We've got a team of 6 now in the province. His background is diverse as well, with the other speakers here today, with expertise in all asset types, principally commercial loans and mortgages, equipment and auto financing, lease financing, consumer loans, and credit card receivables. Dallas's background with debt restructuring, managing distressed assets, and structured financial repositioning is going to serve us well going forward. So Dallas, I'm going to hand it off to you for the last presentation. I want to make sure that everyone that's on the call today is sending in your questions, and once we get through this, we'll get back to the questions and close it up for the morning. Thank you.
Thanks, Richard. I'm going to jump into where my job is to pull things together, as Richard mentioned, and really distill it down to what it means to you in the local market. We've heard from Colliers experts across the country on the current state of capital and real estate markets. Overall, I would say the key points that I took out of it were capital was restricted in March, April, and May, but is beginning to flow again. Capital is flowing to regions and asset classes where the impact has been minimal or is well understood and manageable. Thirdly, lender appetite is selective currently, and regional discrepancies exist. That's high level as to what we heard and where we're at. My role today is this: to answer 2 questions. What does this mean to you, and what is the local impact? The current situation. Talking from a debt advisory financial service perspective, we are receiving calls from lenders looking for new lending opportunities. Not all lenders, but from some lenders. The caveat that I would say is it's only in targeted areas, and targeted areas are similar, but institution and area specific. Give you case in point. Government lease on a piece of commercial real estate is very attractive in the current environment, and we still have lenders bidding each other down from a price perspective. But in other areas, it's quite selective. Each lender is in a different position, and this is directly based on their geography, their current portfolio, and their experience during COVID. For a number of months, many lenders have only made capital available to existing clients, as you heard previously. There was a restriction on new clients, but we've seen this ease in most cases. A COVID-19 questionnaire has become standard practice with most lenders. This allows the lender to assess the opportunity up front and determine whether or not they're interested. Across the board, the borrower process is taking longer to complete. I think that's a generalization, but we do see it on every opportunity. The new normal. I'm not sure we know what that is, but I'll take a stab at it. My first piece of advice is understand where you fit as a borrower, where you fit within the new reality for businesses, and manage your lending partners accordingly. Pricing should not be your primary concern at this time. Availability of credit should be. We've gone through some processes where in the end, the borrower isn't comfortable with the pricing, and it's not the same as it was 6 months ago where that could be their concern. What does this all mean to you, and what is the local impact? I think that's where I committed to come back to. I've got 5 points here. The first one is keep an open dialogue with your financial institution. Understand any concerns that relate to your business and address them now. Don't leave them unaddressed. Prepare for a second wave and have a plan. I think everybody expects, or almost everybody expects, a second wave in the fall. And if business was hit hard the first time, make sure that you have a plan that's going to ensure that you're not going to be hit again to the same extent. For new lending or annual reviews, start your discussions early. Extended time should be expected because there's a lot more questions being asked. Fourthly, have a viable backup lender plan. That is an area where we can help you. And that is an area where we get most of our calls. Geez, I went to my lender and they're not interested in giving me more credit, or they don't want to touch whatever asset that I'm looking to finance. And lastly, assume availability of credit will be restricted. Make sure you've got the resources that you need to get through any foreseen contingencies or slowdown in your business. Really, that's where we sit today. I think what you see is that the flow of capital nationally trickles down to the flow of credit regionally. And even though Toronto is far away for many of you, that's where the capital flows in this country. Lenders are restricted by how freely or not capital is flowing in the now capital markets. I'd like to end the formal session on these points. I'd thank the experts that shared their knowledge and experience with us today. We are very lucky within Colliers to have deep expertise and to have them share that expertise with you and with us. I would do a bit of a pitch as we end here. I'll go back to Debt Advisory Financial Services. As Richard mentioned, it's a one-year-old business line. At the current time, we have approximately 50 lending deals with over $500 million in total appetite on that in our current pipeline. It's from the small to the large. I would say that about half of the business that we're looking at is in Saskatchewan, and the other half is regionally dispersed across the country in various areas. I would leave it at this. We can be there if you want to talk to us. If you have questions in this process, please reach out to us, or if you require more information. I'm going to end on that, and I'll turn it back to Richard for our Q&A.
Okay, thanks, Dallas. Yeah, one question that has come up just yesterday that I wanted to pitch out at you or anyone that can answer this: how many of the lenders that are out there right now are looking for formal business continuity plans or business continuity management structure before they'll go into lending?
I'll answer and turn it over to the panel. I would say that formal, they want something in writing. They're not necessarily looking for a 20-page plan, with the exception of if the business was hard hit in the first round of COVID, they're going to look for more detail in anticipating a second round. One of the pieces of advice I got from a different webinar was that the nature of this pandemic is such that it will not be over until there's a vaccine or some other indication that COVID is at least under control and manageable. So until we see that, I think there's still going to be hurdles ahead.
Okay. Riley, any other thoughts from your standpoint?
I completely agree with Dallas. I mean, it doesn't have to be overly comprehensive, but it really is going to depend on what business you're in specifically. And yeah, how well you can continue operations, because obviously some businesses are better off than others. If COVID does have a resurgence.
Okay, maybe we had a question come in about cannabis. With the recent consolidation in the cannabis industry and business pulling out of certain provinces, how is that impacting the real estate landscape? Adam, did you want?
Yeah, I can answer this. I think broadly speaking, not at all, really. There'll be some, so there's two asset classes that are primarily used by cannabis users. One is retail, so your dispensary type uses, and the other is industrial. And industrial, I would say, applies to packaging and processing facilities, as well as growers, licensed producers, those, or processors, as it were, those types of users. Now, facilities that are used for processing or growing cannabis are highly specialized. They're really in an asset class of their own. And what you are going to see, without a shred of doubt in my mind, is that a number of facilities are going to come to the market as the operating companies fail. We're already seeing it. Many of these producers built facilities that simply don't work. You cannot grow cannabis well in a 50,000 square foot room. What people are finding is that you need to have smaller grow spaces, and that's where the industry is moving. I mean, the cannabis industry is shifting constantly. So the facilities that aren't working are going to go back on the market, and they're going to have a tough time recovering even 50% of what they've invested into them, because another producer is going to see it and say, this facility doesn't work for cannabis. So that's going to create some problems. Broadly speaking, industrial, I don't think it'll have a serious impact, because most of the facilities that were used for cannabis or purchased were in tertiary markets. They were challenged assets to begin with. It's not like they were prime real estate in Calgary, for example. Now, on the retail side, cannabis sales have skyrocketed through COVID because everybody is sitting at home and smoking weed, apparently. So retailers actually haven't struggled as much as you might have expected. There's probably a glut in Alberta of cannabis retailers. Some are not as well located, and they do struggle. So you might see some that end up failing. There might be a few others where they had applied for a license to distribute and they didn't get it, but they entered into the lease in March of 2018, where there was kind of a gold rush for space. So I know a few tenants, for example, a few landlords that have, for example, Tokyo Smoke, which is backed by Canopy, where they haven't been able to open a dispensary because they didn't get the license, but they're still honoring the rent payments. They would be 2.5 years into some of those leases already. Those spaces will probably go back to the market, and then they'll be at a market rate. So that's where I would see more sort of broad impacts. But yeah, generally speaking, the cannabis failure of cannabis in Canada, of some of these producers and retailers, I don't think it's going to have a huge impact on real estate from a broad view.
We've got another question in, just speaking to more on a local basis. Commercial real estate values in Regina and Saskatoon from the beginning of April to June 30th. Are the market trends improving, unchanged, or worsening? And also, what is the outlook for the next 12 months for real estate in Regina and Saskatoon? John, I don't know if you want to take a shot at this from what some of the larger mandates that you're involved in right now.
Sure. No, I'll take a stab at it. I think my answer will be a little bit more high level. So I'll answer that question from a national basis and try and layer in a little bit of local perspective. So from April 1st to June 30th, we did see an overall improvement in market trends generally. Kind of goes back to that investment sentiment survey. We talked about it a little bit earlier. April and 1st, a lot of uncertainty. Nobody really knew what was going to happen. Everybody was focusing on rent collection, whereas June 30th, a little bit more certainty, a little bit more confidence. So overall, markets have improved over that time period. And then looking 12 months out, same kind of answer. Improving, it's going to be better in 12 months than it is today. There'll be some bumps along the road, but generally speaking, most of our investor clients think that we will normalize within a 12 to 18 month period. There are some local nuances for Regina and Saskatoon, and some of my colleagues that I transact with there on a regular basis would certainly be better suited to answer the question than I would be. But I think the answer would be it would depend on the asset, would depend on the asset class, and it would kind of go from there. So industrial probably would fare better than maybe downtown office, particularly if you're talking about Saskatoon. And multi-residential would probably fare next.
Yeah.
Anything you want to add to that?
Yeah, I'll add to that as well, just more at the local level, because we do talk about this quite a bit. And you know, the interesting thing when you presented the national perspective, John, our data is aligned with that. The industrial market's still stable. Multifamily is strong. The things that we were going into pre-COVID with an evolution in both cities in the office sector are going to be exacerbated by COVID, but it's still a market in transition, flux on office. The retail sector is interesting because we had a couple of long discussions in both cities. There's going to be a change in rates for sure. There's going to be a shifting and repositioning, but fact is that you can't paint the retail sector with one brush. It varies by subclass. It varies by management style. It varies whether it's local and national, how deep the pockets are, and how creative the owners or operators of retail sector entities are. So it's a little bit all over the map, but for sure, you know, I think what we're trying to sort through is whether or not, how much of this is a health crisis versus an economic crisis, and are we going to create something that isn't real, whether positive or negative. So for the most part, a recovery, stable recovery, but as well, there's many of my colleagues here that are saying it's still a little bit too early because there's this fear of the second wave, the next bubble, and looking out a year to 18 months, will there be a lingering effect on businesses or cash flow when reality sets in? What's the next 2 years going to look like, for example? So I had one last question, then we have to close up here, and this is for in the lending world, and possibly John, you might have a comment as well. But the appetite for lending, one thing we learned out of COVID is we do need to eat. Food is an essential ingredient to survival. Has there been a shift in lending appetite into agri-food and into the agri-food and agri-value sector?
Well, I'll give you some general thoughts on it. I don't think lenders that were not active in the space prior to COVID are not all of a sudden entering the space. I do think that the sector is held up reasonably well. I mean, there were some blow along the way. So I think that capital is still reasonably strong in that space, but it's not bringing in new lenders as of yet, if that makes sense. It was a selective area prior to COVID, and it is still a selective area, but the appetite of those lenders is still reasonably strong.
Yeah, I completely agree with Dallas on that. It's certainly not drawing in new lenders that weren't already in that area.
Okay, with that, again, thanks panel, and thank you everyone who committed the time this morning to listen to our insight. Please reach out if we can help. Our contact information is on this page. The presentation will be available at some point, and have a safe day and good luck for enjoying the rest of the summer. Take care.